Ever wondered how investors and analysts really see a company? It's not just about looking at the top-line revenue number. They dig much deeper, and one of the key tools they use is financial ratios. These aren't some complicated formulas just for experts. They're surprisingly straightforward ways to understand a company's financial health. And understanding them can give you a real edge, whether you're considering investing, running your own business, or just trying to make sense of the financial news. So what are financial ratios? Simply put, they're calculations using figures from a company's financial statements, things like the balance sheet, income statement, and cash flow statement. These ratios take those raw numbers and turn them into meaningful percentages or figures that can be compared to the company's past performance, its competitors, or industry averages. Think of it like checking a patient's vital signs. Blood pressure and heart rate are just numbers, but together they tell a doctor a lot about the patient's health. Financial ratios do the same thing for a company. Why are they so relevant, especially here in the US? Well, the US has a huge and competitive market. Investors have tons of options, and they need ways to quickly and efficiently evaluate those options. Financial ratios give them a standardized way to do that. They cut through the noise and help investors compare apples to apples, even when dealing with companies of different sizes. They're also crucial for lenders, banks, for example, who use them to assess a company's ability to repay loans. Let's break down two major categories: liquidity ratios and profitability ratios. First, liquidity ratios. These tell you how easily a company can meet its short-term obligations, things like paying its bills, salaries, and suppliers. Imagine you're running a small business and you need to pay rent next week, but you're waiting for customers to pay you. A liquidity ratio helps determine if you have enough readily available assets to cover that rent. The most common liquidity ratio is the current ratio. It's calculated by dividing current assets, things like cash, accounts receivable, money owed to the company, and inventory by current liabilities, things like accounts payable, money the company owes, and short-term debt. A current ratio of 2 or higher is generally considered healthy, meaning the company has twice as many short-term assets as liabilities. Let's say a company has $200,000 in current assets and $100,000 in current liabilities. Their current ratio is 2, suggesting they're in a good position to meet their short-term obligations. Another useful one is the quick ratio, which is similar to the current ratio, but it excludes inventory. This gives a more conservative view, as inventory isn't always quickly converted to cash. Now, let's move on to profitability ratios. These tell you how well a company is generating profits. It's great to be liquid, but a company also needs to make money. These ratios get to the heart of a company's efficiency and effectiveness. The gross profit margin is a key one. It shows how much profit a company makes after subtracting the cost of goods sold, the direct costs of producing the goods or services it sells from its revenue. It's calculated as revenue cost of goods sold / revenue. A higher gross profit margin is generally better. Let's say a company has $1 million in revenue and $600,000 in cost of goods sold. Their gross profit margin is 40%, meaning they keep 40 cents of every dollar in revenue after covering the direct costs of production. Another crucial one is the net profit margin. This goes a step further than the gross profit margin and takes into account all expenses, things like operating expenses, interest, and taxes. It's calculated as net income / revenue. A higher net profit margin indicates the company is efficient at controlling its costs. If that same company has a net income of $100,000, its net profit margin is 10%. The return on equity, or ROE, is also very important. It measures how much profit a company generates for every dollar of shareholder equity. It's calculated as net income / shareholder equity. A higher ROE suggests the company is effectively using shareholder investments to generate profits. Now let's put it all together. Imagine two companies, A and B, both in the same industry. Company A has a high current ratio, indicating good liquidity, but a low net profit margin, suggesting it's not very efficient at controlling costs. Company B has a moderate current ratio and a high net profit margin. Which company is a better investment? It depends on your investment strategy, but Company B generally presents a stronger financial profile. Financial ratios aren't perfect. They rely on historical data, and a snapshot in time doesn't tell the whole story. They can also be manipulated, though good analysts can often spot that. It's important to use them in conjunction with other forms of analysis and consider the specific industry and economic conditions. They're tools, not crystal balls. To recap, financial ratios are powerful tools that allow you to assess a company's financial health. Liquidity ratios tell you if a company can meet its short-term obligations, while profitability ratios tell you how efficiently it's generating profits. By understanding these ratios, you can make more informed investment decisions and better understand the financial world around you. Remember to always look at ratios in context and compare them to industry averages and competitors. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.